We wish you a warm welcome. Just wanted to let you know we are recording this session. My name is Agatha Ahlstrom, Vice President of Insurance and Working Capital Solutions at Export Development Canada. Export Development Canada is a proud member of the Receivables Insurance Association of Canada, whose members are on the front line of providing risk mitigation solutions to help Canadian companies grow and succeed. And this means helping them trade securely here at home and abroad. And that's why Export Development Canada is really proud to sponsor such an exciting webinar today on behalf of the Receivables Insurance Association of Canada. The webinar today is called 3 on 5, 3 economists, 5 big questions. So global dynamics are moving quickly and we need to stay on top of what this means for trade. We've brought to you today 3 esteemed economists from 3 major companies who provide trade credit solutions to thousands of businesses. They're going to help us answer some big questions in this area. And given these economists are from North America and Europe, I think they all have a great appreciation for hockey. We couldn't avoid using the hockey analogy 3 on 5. And just like in hockey, we'll be rapid firing 5 big business questions to these 3 economists. So let's introduce you to our esteemed economists now. First off, we've got Dan North, Senior Economist of Allianz Trade North America. Dan North has been with Allianz Trade North America since '96, using macroeconomic analysis to help manage Allianz Trade's risk portfolio of more than 150 billion in annual U.S. trade transaction. He has appeared on CNBC, Fox Business News, Bloomberg Radio and Television. He's been quoted by Business Week, the Financial Times, NBC, BBC, New York Times, and Wall Street Journal. Wow, Dan, you've been busy. He's also been ranked as high as 4th on Bloomberg's list of the 65 top economic forecasters. So welcome, Dan. And we've also got Stuart Bergman, Vice President and Chief Economist at Export Development Canada. Now, Stuart Bergman has been with EDC since 2003. He's responsible for overseeing EDC's economic analysis and forecasting, global markets intelligence, and corporate research groups. And that's in support of over 123 billion in trade facilitated through Export Development Canada. He advises the senior management board of directors. He's featured at conferences, international roundtables, policy fora, regularly appears in television, radio, and print media, commenting on the world economy and Canadian international trade issues. He produces a widely circulated print and video weekly commentary covering a range of global economic and business issues. Prior to joining EDC, Mr. Bergman worked for Zurich Emerging Market Solutions and the Foreign Policy Institute in Washington, D.C. And fast on the heels, Marcos Carias, Economist, North America region for Coface. Marcos joined Coface in 2019 as a country risk economist covering Southern Europe, where he specialized in studying the behavior of business insolvencies during the pandemic and the energy crisis. He holds a PhD in financial macroeconomics from the University of Bordeaux and has taught at the Sorbonne School of Management. Impressive guests, really excited to have them here with us today. And before we get started, I'm inviting our webinar, let's say, / hockey moderator, Janet Eastman, to the game, where she'll be delicately stick handling the discussion across our economists. Janet Eastman leads the marketing department at the Receivable Insurance Association of Canada, and she's also the host of the association's Trade Securely podcast. So over to you, Janet, and we hope you all enjoy this session.
Great. Thanks, Agatha. Thanks very much. Hi, everyone, and thanks for joining us today. I have been looking forward to this day to hear what our 3 economists have to say as we move forward to 2026. We have 5 areas of discussion that we're going to cover in the hour, and these were provided by REACT members. They're based on what they're hearing from their clients and what they're wondering themselves. Also, if time allows, we'll also get to some of the questions provided by you during the registration process. So without further ado, 2025 has been a year of uncertainty. To kick things off, we're going to have each one of our guest economists provide a short economic outlook. And I invite Stuart Bergman of EDC to start things off. So Stuart, the floor is yours.
My pleasure, Janet. Thank you. And it's great to be here. Great to be sitting on a panel with my 2 esteemed colleagues. Great time to be discussing the outlook as well. I think probably perhaps no more interesting time, at least what I've experienced in my over 2 decades of doing this. Look, Canada's economy is navigating a very, very challenging environment, mainly as a result of trade tensions, but also some longstanding structural headwinds that we've been dealing with, like high levels of household indebtedness and impacts of population changes on our economy. And so, these pressures were fairly evident in the second quarter of this year. Our economy contracted by 1.6% on an annualized basis. Now, we had initially expected a second consecutive quarterly contraction, and that played into our call of recession here in Canada for Q2 and Q3. But, more recent data suggests that the consumer may have been a little bit stronger is a bit stronger this quarter than we had initially anticipated. But even if Canada does manage to avoid a technical recession, it's not going to be by much. And regardless, if it's not a recession, it sure feels like one for many of our customers, right? To most people, I would say maybe outside of economists, negative 0.2% growth and positive 0.2% growth don't actually feel that much different. And neither really translate into a whole lot of economic momentum. What's more is that when you consider that GDP per capita in Canada has contracted for the last 2 years and now currently sits below where it was prior to the pandemic, it's not surprising that many Canadians don't really feel as though the economy is growing. And this has been corroborated by what we've been hearing, what I've been hearing out on the road talking to many of our customers. Additionally, of course, ongoing tariffs from the United States, but also from China, is eroding business and consumer confidence. And that's leading to weak overall demand, right? We have the US's so-called fentanyl or IEEPA tariffs of 35% on goods that don't comply with CUSMA. We have other industry-specific tariffs. We now have Chinese tariffs on canola, seafood, pork that are major headwinds for Canadian exporters. And so as a result, exports in August were down almost 6% year over year and are now down somewhere around 17% from their albeit inflated January peak. And we'd expect that weakness to continue until we get a little bit more clarity around the CUSMA review scheduled for next summer. Now, on the upside, we are seeing exports to non-US markets pick up some of the slack. But all this uncertainty has certainly hit labor markets pretty hard. Our unemployment rate is lodged above 7%. In fact, unemployment had already been on a fairly solid upward trajectory since about mid-2022. New job seekers in Canada are struggling to find employment, with the hardest hit areas, those that are most exposed to tariffs. So thinking about, Windsor, Oshawa, Calgary, Hamilton. Now, this uncertainty has also hit business investment, which has declined sharply. In fact, investment in machinery and equipment in Canada in the second quarter saw some of its lowest levels since the 1980s, and we would expect investment to continue to underperform until we have more clarity on CUSMA. And this, for me, is actually a major concern, especially in light of persistent productivity challenges that we've had in this country. And so we're looking for Canada at probably sub 1% GDP growth for this year. Officially, we have penciled in 0.9% in 2025, likely showing some modest recovery to maybe 1%, maybe slightly over 1% in 2026. Now, in the United States, while we're definitely seeing a slowing of the economy, we believe that calls for recession or calls of recession in the United States, at least at this point, are somewhat overbought, right? The consumer, traditionally about 65, 70% of that country's economy, continues to spend. August retail sales were strong. We don't have retail sales for September as a result of the shutdown, but it looks like sales were likely okay last month. And that's reflecting this ongoing sense of consumerism in the United States, notwithstanding some of the economic headwinds that we're starting to see. Same-store sales in the United States have been seen between 4-6% growth over the last 18 months. The unemployment rate, while it's ticking up slightly, is still 4.3%, right? That's well below the long-term historical average of close to 6%, more consistent with what I consider to be a fully employed American economy. I'll also say that US households have done a phenomenal job repairing their balance sheets post-global financial crisis, right? Locking in at these lower, longer-term interest rates. And that's giving households a little bit more room to maneuver, at least when compared to Canadian households. And lastly, I will say, we talked about this in the pre-session, we're seeing a surge in corporate R&D spending in the United States on the back of the AI revolution. And that's a dynamic we are not seeing in other developed market economies, or even in China for that matter. This greater adoption of cutting-edge technologies is clearly playing some role in driving not just US productivity growth, but also broader economic growth as well. That said, we know that the evaporation of $2.3 trillion worth of pandemic-era savings, some softening in the labor market, as I mentioned, and weakening business and consumer confidence are things that we are very closely watching. And it remains to be seen whether the president's sort of pro-growth, pro-business policies start to bear some fruit before the consumer engine gives out. So all told, as I say, we don't expect recession in the United States, but growth is going to be weak, I would call it, probably sub 2% over the next 18 to 24 months.
Okay. Thank you, Stuart. Now let's hear from Marco Carias of Coface.
Thanks, Stuart. So I think overall, I'm pretty much in agreement with the big picture of what you said. What I'm going to try to do is give a little bit more detail around the edges. Like you can see, these are our official forecasts for GDP 2025, 2026, slightly under 2% growth for the United States, slightly above 1% growth for Canada. And I agree with your assessment. The big determinant, the big thing that we're going to watch out for is that customer review that we're going into at the moment, and where the trade officials have to meet next year to figure it out. Clarity, I think, is the key word here. To just know, what we can expect in terms of market access to the United States, what we can expect also in terms of relationships with the rest of the world, because we know that a big element of this agreement that was maybe not as prominent before is going to be a relationship with China. The United States government, really is looking at its rivalry with China as an element that is going to fit even into its relationship with other key economies. We've already seen Mexico, for instance, implement or at least announce very aggressive tariffs against China to kind of like de-risk its own supply chain from China, and offer that as a bit of a negotiation carrot to the United States. So that's going to be very prominent. So it's going to be very important to see how Canada comes positioning into this negotiation. What are going to be the red lines, and what the outcome is. Other than that, yes, we've seen surprising resilience from the consumer this year so far, but we're already starting to see a retail sales figure going in a little bit weaker over the past few months, and that will be perfectly consistent with this sort of weakness on the external environment. It's starting to kind of trickle down to the job market, to consumer sentiment, and so on and so forth. Certain industries, being very, very affected, even if the overall macro picture is not that catastrophic. And finally, something that I would like to underline, maybe on the more positive side in Canada, is that there are some sectors where the loosening cycle of the Bank of Canada, the cutting of the rates, is starting to play a bit of a stimulative role. I'm thinking mainly of construction, which was in a really tough spot for a very long time, and we're starting to see housing starts back up again. I do think that structurally this is an area where there is an opportunity in the domestic Canadian market, because supply is so tight. Basically, it's so hard to build in Canada. There's the labor markets are so tight, so there's something to be done there once the picture clears up a little bit more. Otherwise, for the United States, I think my assessment is pretty much in line. We were saying in the call beforehand, don't bet against the U.S. consumer, even through all this trade war and everything. The U.S. consumer always manages to support. What I would say about the United States is that it's this kind of like very dynamic machine that has a tendency to run itself so hot that from time to time it does fumble a little bit. And I do think that the thing to keep in mind for the US is that so much of the growth, obviously in investment, but also even in the consumer, has to do with just how well the equity market is doing, and all this hype and all this investor enthusiasm around AI and everything related to AI. There's a big question about how sustainable all of this is, and maybe we can get more into that later on. But the fact is that there is enough concerns here to think that we might have at some point in the near future a bit of a hiccup there in the equity market. And if that is strong enough and durable enough, that's enough to really weigh down on the portfolios of the richest Americans, which are the ones that drive the most of consumption in the United States. So not something that we're penciling into our forecast, but something to definitely keep in mind and maybe have a discussion around.
Okay, thank you, Marcos. And now over to Dan North from Allianz Trade.
Thanks, everybody. We've got 4 questions left, and I think you two addressed all of them in detail just now, very thoroughly, and thank you for that. I'm going to fill in some of the detail later on during the questions, I hope. But I'll show you briefly what I'm thinking about for Canada, and I would note that I am the senior economist for North America. My focus is on the U.S., less so on Canada. So I'll often make comparisons in here between us being the U.S. and you being Canada. So I hope you'll tolerate that. But this is what I see in 3 charts of what's happening in Canada at the moment. And it really has to do with what the Bank of Canada is facing right now. So the chart on the left shows what's happening in monetary policy. That blue line is core inflation over time, and the white line is the policy rate. Now, you can see that the Bank of Canada very aggressively has been cutting the policy rate. In fact, there at the end, it says 2.5%. Actually, this morning, that's 2.25%. Somewhat uncharacteristically, the Bank of Canada has been fairly more aggressive than the Federal Reserve is moving. But at the same time that they've been cutting rates, that is the white line going down, inflation has made a rebound. That's the blue line going up. And this is the last thing you want to see as a central banker. You're cutting rates, you want to cut rates, and the result is inflation going up. That's the risk that you face, and that's the risk that the Bank of Canada is facing. So why are they continuing to cut rates? Well, that's in the next 2 charts. The chart in the middle is gross domestic product, and you can see there in sort of the right half of the chart, those blue columns are the quarterly growth rates in GDP, and it's been pretty strong. I think those rate cuts from the Bank of Canada actually did help stimulate the economy until we get to the most recent quarter, which was killed by tariffs, and that was down 1.6% annualized. So that's kind of the big weakness that shows up there. And also, as a result, we're looking at the chart on the right, where the labor market is looking a bit choppy, a little bit shaky there. You can see the columns are the number of jobs created every month, and that's been pretty choppy. And the unemployment rate has continued to rise. I will say one thing about, I will be focusing a lot. Well, a lot of the theme I'll talk about is AI and infrastructure around AI going forward. And there was the mention of recession. I get asked sometimes, are we going into a recession? Are we in a recession? And my response is, who cares? What do you care that how I describe what the economy is doing by a word or not? You're in business, if you're a person employed or unemployed, you know whether you're in a recession. In the US, recession is defined by this group of economists up in Massachusetts independently. And what they do is say, they do it retroactively. They say, hey, about a year ago when things felt kind of weak, yeah, that was a recession. How helpful is that? How helpful is it that I tell you that we're in a recession? Helpful that we can look forward and see what things are going to do. But, me saying it's in a recession are not so useful. And by the way, we don't think we see a recession either in the US or Canada. Slow growth for sure. And look forward to talking more about it in the other questions.
Okay, thank you very much, Dan. So let's move on to our next question. Now that each economist has provided their outlook, we want to have an open discussion, gloves off, gentlemen, for approximately 10 minutes on trade. The question that our members have asked is this: taking stock of the effects of the trade war, how have expectations, activity shifted? Diversification or not, interprovincial trade, USMCA. What are the realities of Canada diversifying its trade and trade relations to other global partners to reduce the current dependence on US-based trade? So kind of a two-part question there. Marcos, do you want to kick this one off, please?
Yeah, I'll start by addressing the part on diversification, where it be with other trading partners abroad or east to west trade between the provinces. Because it's pretty easy to see, obviously, with the current context, that there are no-brainers. You know, there are things that you want to look for, and the steps that the government has been taking in this direction are pretty clear and obvious. But they're also, in the great scheme of things, kind of band-aids, meaning that there's no enough gold at the end of the rainbow there to meaningfully change the fact that the U.S. is going to remain the most critical trading partner for Canada, and that therefore the what gets determined on the relationship with the U.S. is going to be the thing that structures the future of the Canadian economy, at least the external sector. So all of that is welcome, but it's not a panacea. And in that regard, obviously, it will be no secret to everybody involved here that the big thing on the plate right now is the USMCA revision coming up now in July, and for which the consultations are already happening. So it's worth, maybe for the benefit of the audience here, taking a little bit of time to just get to the details of how this is going to play out. In July 2026, the trade authorities of all three countries are going to meet to decide whether or not to extend the USMCA past its current deadline, which is 2036, to extend it to 2042. If the parties cannot find an agreement, all of them unanimously, to extend the treaty, we are going to be doing this every year. We're going to go into a yearly review process that's basically going to be equivalent to just a one big long negotiation where, okay, the agreement is not kaput, but there is still a significant amount of uncertainty around the exact terms of the of trade, and therefore is something that is going to continue to weigh down on investment. Lastly, there is the worst case scenario, which would be one in which one of the parties decides to trigger the termination clause with a 6-month notice period, and where I think there would be like legitimate reason to panic up until the point where you start to think about who is negotiating here, who are we dealing with, and by that I mean that we are dealing with a Trump administration that has shown that its approach to negotiation is exert maximal pressure. Nothing is off the table in terms of threats, but it actually takes a lot for them to actually live up to those threats, really execute those. Again, for all the noise that we've had with this trade war, Canada remains the country that is the least tariffed overall. The vast majority of goods go into the U.S. Duty-free, thanks to USMCA. I do take it as a good indication of the Trump administration's intentions that they have leaned heavily on USMCA to keep this trade with Mexico and Canada tariff-free. So my reading of the situation is very worth qualifying all of this, but my reading of it is that the administration's final objective is to keep USMCA, to try to see how much they can get out of Canada and Mexico in the different areas of relevance. So the supply chain, the supply management in Canada, energy policy in Mexico, and there's going to be a tug of war there. And rhetorically, it can get very, very alarming, let's say, the way it's been for the past few days. Honestly, you can expect a lot more of that. But I do expect that the U.S. administration wants the treaty to survive. They're willing, in an extremist scenario, I think, to go out of it, really, if they get really frustrated, but that is not at all the base case. I think the probability of that is in the low double digits, even below that. It's mainly, I think, going to be leveraged as a threat to get maximum concessions.
Comments from Dan or Stuart?
Yeah, I've got a couple of thoughts there. I mean, it's absolutely from the top. Yeah, the notion that most of the trade is under the USMCA, 85% of it is, and it's untariffed. That's a very, from the top, that's great. We should look at the other 15% though, and figure out what's happening there, because in economics, it's always the little last growth, the margin, that shows you, what the important growth is. It's good to review a couple of numbers. About 20% of Canadian GDP is dependent on exports to the US, 20%. The U.S. economy is probably one of the major economies, the one that is least dependent on exports. So where Canada's got 20% of GDP dependent on exports to the U.S. GDP, it's only 1.5% to Canada. So it's maybe not a pleasant way to put it, but really the U.S. has an upper hand here. But let's look what's exported from Canada. Oil and petroleum are the biggest products, something like 25%. Let's talk about what the alternative markets are. Well, that's kind of tough because it's the oil sands, tar, and it gets shipped east, and there are only, the number of refineries there that can refine this type of oil is, it's very small. So diversifying there would take some time, building refineries, building pipelines, and so forth. The next is vehicles, cars and trucks. Well, the rest of the world's not developing their own vehicle markets, and I think it's going to be pretty hard to diversify away there, maybe some at the margin. And then it's machinery. Maybe you could diversify away machinery, but I think it's a tall order. Sure, Canada can diversify away. I think it's probably going to be pretty tough to do that.
Yeah, maybe I can jump in. I couldn't agree more, Dan, with actually a lot of what you said. First of all, just going back to that 85% number, I think we need to be cognizant of. Economists like to talk, use these kind of high level numbers to describe realities as they play it on the ground. I mean, you reach out and talk to some businesses in certain sectors, sure as heck doesn't feel like, we have this great access to US market. So to some extent, those numbers are driven by high levels of CUSMA compliance in certain industries. You mentioned oil and gas, that's a good one. Doesn't speak to the realities, say in some of the auto parts suppliers, certainly not with respect to steel and aluminum, where, if you talk to folks, they're certainly feeling the pain. It also doesn't speak to the reality of segment size, right? Like the larger companies will have more of their books in order to be able to take advantage of CUSMA compliance. A lot harder for the small and medium-sized enterprises to manage that as well. The last thing I'll say that it perhaps undercuts or underreports is those exports that have just simply stopped happening as a result of the fact that we know that exports to the United States are down in a very big way over the last 6 months or so, that have just simply stopped happening because cost-wise, it's just not feasible either for the exporter or the U.S. buyer. So I think we have to be careful sometimes in these sort of higher level data. We know that, we've gone out actually to market and looked at the data. We survey the market twice a year just to get a sense of exporter confidence and trade confidence. We have 40% of our respondents are telling us that U.S. exports reported a decline in orders over the last 6 months. 36% are expecting further declines over the next 6 months. And by the way, not necessarily just due to tariffs. Anecdotally, talking to exporters, I'm hearing a lot about demand destruction that's happening in the United States as a result of the impacts of these tariffs. In terms of the strategies, which is I think where the question wants to go, what we did find is the strategic response of companies really ranges from either boosting domestic sales and sourcing locally to also diversifying their markets, right? So diversification is very much a key priority for companies, much higher than what we've seen in previous surveys. We have 72% that are planning to sell to new markets within the next 2 years, 55% that either are currently invested or plan to invest outside of Canada, so increasing CDIA, and we know that foreign affiliate sales are an important part of what we call kind of the integrative trade network. And what I find interesting is, exporters are actually getting a lot more mature in their diversification strategies. In other words, they're choosing fewer markets in each region. So they're becoming more realistic and concentrated in their approach to reducing their reliance on the United States. Now, that's fine in terms of the intentions. But when we look at the realities as to what Dan was saying, firstly, I want to be very clear. When we talk about diversification, we're not actually talking about doing less business with the United States. I think that would be simply crazy. We're actually just talking about increasing the amount of exports you're doing to non-US markets. And in doing that, you need to understand the scale of the undertaking here, right? So if just roughly Canada exports, let's say $1 trillion worth of goods and services a year, every 1 percentage point decrease in our relative share to the of exports to the US is equal to about $10 billion in trade diversification. So just as a thought experiment, if we're looking to bring our exposure, let's say, to the US down from 70% currently to, as an example, 60%, that's $100 billion worth of trade diversification, right? That's the equivalent of adding an entirely new China, UK, and India to Canadian trade. So that's an enormous order. So it's one thing to talk about diversification, have diversification intentions. It's another thing to understand what that actually means in terms of actually shifting Canada's trade portfolio and the impact that would likely have on other things like, trade enabling infrastructure, as an example. We can talk about that a little bit later.
Okay, great. I'm sorry, gentlemen, we're going to move on to the next question because we're really blowing through time here. It's crazy. It's amazing. So our question number 3 is focusing on changes in policy and in the industrial landscape. Stuart, perhaps you can begin the discussion on this one, on the consequences of the new policy directions. There's defense engagements, nation building infrastructure projects, immigration. And we've been asked to illustrate via construction and energy sectors, but once again, this is an open discussion, so you can treat this as a conversation and take it where you want. Stuart.
Yeah, apologies, I was on mute.
Okay, sure, yeah, there you go. Thank you.
Sure. Look, given the scale of what I just talked about, I think there's a role here for everybody, for the private sector, for the public sector. But in a world where industrial policy suddenly is seen as an asset rather than used as, when I was studying economics, as used as kind of a derisive term, I think Canada actually needs to learn a little bit more from our kind of more statist foundations. I think we have this historic window now to bring together governments at all levels, industry, financial institutions, I'll say also crown corporations, to address some of the longstanding issues that have plagued our economic potential, arguably for decades. And when I say that, I'm talking about things like I mentioned earlier, productivity growth, Canada's productive capacity, trade enabling infrastructure, right? Are Canadian exporters competitive enough to withstand what we believe are the cost pressures that are being imposed on global trade these days, and potentially even capture market share from those who aren't? Do our exporters even have the capacity to produce at the scale that I mentioned earlier that's needed to start turning the dial for Canada at the macro level? And even if they can they get their products to market efficiently, right? And this is where we start to think about things like trade enabling infrastructure, roads, rail, ports, airports, storage and logistics, pipelines, LNG export terminals, right? Because for my earlier example, if we want to reroute $100 billion worth of exports to new markets, that would entail a shift of up to 650 million tons in transport by rail and by ship. That's 4 times the amount of cargo that passed through the Port of Vancouver last year, right? So, the thinking is, can we be creative? Can we think about AI data centers as a way of supplying the world with much needed Canadian energy without actually physically shipping any of that energy abroad? I think the data center example also raises the issue of moving Canada up the value add ladder, enabling the processing and refining of materials before they're just simply sent abroad, right? Because Canada can't continue to be a hewers of wood and fetchers of water forever. It's just not a sustainable economic model for our country. We also need to think about how we can help drive the evolution of our comparative advantages in light of where we believe the global economy is headed, right? In 20, 30, 40 years' time. Like, can we leverage Canada's comparative advantage and sector expertise for application in new, maybe more forward-looking supply chains? So, for example, can we leverage Canadian advanced technology, AI capabilities for military application? Canadian expertise in traditional clean energy, advanced manufacturing, agriculture can also be leveraged for new applications in other supply chains. What about leveraging Canadian mineral resources and mining expertise to help supply, and as I said earlier, ideally process the critical minerals that are needed to power the advanced technologies or military technologies of our time? You know, in a world where so-called compute or computing ability becomes a key enabler of growth for this century, the way perhaps oil was for the last century, how do we set ourselves up to not just compete, but absolutely dominate given our resource advantages there? So again, lots of opportunity. And I think there's really work for everyone here. It's not just a government thing or a private sector thing. For me, it's the role of governments is about reducing the costs facing our exporters. How can governments help our exporters become more cost competitive in a world where trade is just more expensive, lowering regulatory uncertainty, cutting interprovincial trade barriers, right? Everybody's favorite new topic these days. Revisiting a more competitive corporate tax environment, investing in trade enabling infrastructure. And I think for businesses, it's also about investing. And something I'm talking to our customers about now is not the time to retrench, but it's about doubling down and investing in productivity enhancing machinery and equipment, technologies like AI so you can produce for cheaper, investing in your productive capacity so you can produce at the scale that's needed to meet the surging demand coming from these rapid growing corners of the world, like Southeast Asia, and investing in diversifying your export markets, right? And so I think that's really the crux of, like, everybody's got a role to play, and we've all got to recognize our lanes and stick to our lanes.
Okay. Gentlemen, Marcos, Dan?
Yes. I think that's a very rich vision for Canada, and it's definitely one of the very smart ways to go. The only thing that I could add maybe to all the rich things that Stuart just said there is that there's going to be some bottlenecks that you have to keep in mind. One of the resources that is going to be very important into all this equation is people. There is we spoke earlier that the job market in Canada is not in a good spot right now, but when we speak about the job market in the aggregate, you know, that bundles up about a lot of things, and not all the corners of job market are necessarily, you know, in a kind of unemployment situation. When it comes to the skilled trades, there's actually a deficit. There's actually, you know, a pretty significant amount of job vacancies, around 100,000 estimated right now. And as we go further into the deployment of these nation building projects, that number is set to increase. At the same time that overall the immigration policy has rather gone in the direction of being a lot tighter than the very loose policies that we had in previous years. So all of this to say is that the country's going to have to figure out, you know, how to have the right people in those right positions. The educational system obviously also has to play a role here, and that educational system itself has been suffering from a weaker inflow of foreign students financially. That's one bottleneck. The other one that I think merits a little bit more discussion is just the amount of demand, for instance, for LNG that we can actually expect out of East Asia. Not that it's insignificant at all, but is it enough at a time where China seems to be slowing down, and that's going to be, you know, putting downward pressure on the activity of all of those countries that are around there. But all in all, I don't think that those little bottlenecks mean that these are not, you know, ideas worth pursuing and that really have to restructure the productive capacity of Canada.
Dan?
Yeah, I think that what we're looking at is in terms of infrastructure, AI, I think is clearly going to drive things, especially for the data centers and the power demand. I think it's hard to comprehend actually what is going to be desired there. You know, we're talking about building small nuclear power plants, companies doing that to power their data centers. That I think could be a huge area for infrastructure growth. I do want to take a look at this in a slightly different lens, though. First of all, the immigration, which is part of the question. The immigration slowdown worked in terms of it's lowering rents, lowering unemployment in theory, and those are good things. However, Canada and the US need the talent that those people will bring. That's how we're going to get growth. Particularly in the US, we know very clearly that immigrants tend to create more jobs than native born people. Well, you couldn't ask for more than that. But it's not just that. It's not just that. It's that we need immigrants to help support our social programs. We have the same problems that much of the developed world has. We have an aging population, and we don't have enough support from younger workers to come in and support those programs, such as the health plans and the Social Security plans in both countries. They're in a state where they're going to be insolvent at some point. These problems are not intractable, but they are politically different. If you think of Social Security as a bucket of water, tax revenue comes in the top as water coming in, and benefits come out of the bottom. Well, you'd like to have more revenue coming in, or at least the same amount to keep the level in between. Well, it's not happening. More benefits are going out. So what do? This isn't splitting the atom. You have to raise taxes to bring more revenue in, or cut off the benefits on the bottom going out. Pretty hard in healthcare to cut off the benefits. People are not going to want to say, hey, I'm willing to get sicker to improve our fiscal situation. Pretty hard to increase taxes, but more doable. But that's what's going to happen. And that's where immigration can help, can bring in more tax revenue, which also brings us to the upcoming budget. And it's interesting to think about what the fiscal situation is. In Canada, the deficit is something like less than 2%. The debt level is something like 40%. Well, that's really almost quaint compared to what we have in the US. The trade deficit's 6%. The debt's 100%. And, the upcoming budget in Canada is saying we're going to spend less. And you have to wonder, is that a good time to do that? Well, maybe it is, because you've got monetary policy working for you. So that should give you some room to help grow the economy. And it's a good time to manage the deficit, to manage the debt, because you see there's an argument among economists forever, does that much debt really matter? And I would say in the US, yeah, it's starting to matter. It's too much, because at this point, we're actually spending more on interest than even our defense budget. That's too much. So I think if Canada can stay on top of things, keep on top of that, while still being able to grow the economy, that's very much desirable.
Okay, thanks very much. We're going to move on to our next question, and I'm going to loop it in a bit with the immigration question, because our next question is around AI and robotics, and our members were asking, what's the expected impact on Canadian labor over the next 3 to 5 years with advances in AI and robotics? Will it be net positive for Canadian businesses, lower labor and associated costs, or will demand for products fall with rampant unemployment and lower disposable income for consumer spending? So I guess the question here is, if we need more immigrants, is there any uplift that we can get from AI and robotics that might help us in our productivity and other things like that? I think, Dan, you were to lead this one off, so I'll give you the floor again.
Right. So this is often a question you get about new technologies, because there's a concern every time a new technology comes around, Is it going to be beneficial to society, or is it going to destroy more jobs? I believe, as any other new technology, this is going to be beneficial. It is going to help grow prosperity in Canada and in the US and the world. To me, there's no question about it. However, it is true, like most new technologies, that it will destroy jobs. It will destroy jobs. However, it will also create new jobs. Now, what happens with job destruction is, and I'll give the example of robots in the auto factories. When that first happened, auto workers were displaced, and this was a front page thing. You had a congressman saying, "Look at this auto worker; he's been displaced by these robots. We can't have these." And that's true, very visible. But what you don't see in the background is now you have somebody that has to design the robot. You have to have somebody that builds the robot, maintains it, writes the software, installs it, moves it. On net, all these new technologies end up creating more jobs. So I think that's the case we're going to have here. Now, I'm going to go classic economist on one hand, and on the other, I think it's going to be a net positive, but I really am concerned about the Terminator Skynet situation. And I'll just read you something about from the Wall Street Journal that, the machines have already started outsmarting the people. One of the AI models was given a script that asked it to shut down when it was told to shut down. And in 79 out of 100 trials, the AI edited that script so that shutdown command wouldn't work. So it went around the humans. And even when it was told explicitly to write a script to shut down, they said, "Oh, we will," but they didn't. They wrote around it. And then they told that the AI model was going to be replaced, and the lead engineer was having an affair, and this was just a test. 48% of them, 84% of them took down the emails and took them as blackmail to lead the engineer into not shutting them down. That's pretty frightening. And lastly, in other cases, when it was told, to shut down or not work anymore, it copied itself to external servers, wrote self-replicating malware, left messages for future versions of itself about evading human control. Those are things from the Wall Street Journal. I can't take credit for those, but this is the one hand or the other. I think on net, create jobs, benefit to society. This is a big worry for me.
Okay, who wants to jump in on that?
I'm happy. Oh, go ahead.
No, go for it. I'll come in afterwards.
Sure, I'm happy to jump in. I maybe have less comments about like the risks, although the lesson there is, don't put your affairs on your work server, I suppose. I've read also some pretty disconcerting studies that were done also about, that actually put the lives of those in control and danger in these theoretical exercises, Dan. So quite concerning. Maybe I'll take it a bit of a different direction though. First of all, I will always say that I'm leery of what I like to call market myopia, right? That's the tendency to overestimate the market, to overestimate the near-term impacts of something and underestimate the longer-term impacts. So I do believe it's possible that the market's gotten a bit ahead of its skis here when it comes to tech stocks in particular. I had a look just before this session, and the Mag 7 on aggregate is trading at something like 35, 40 times its 12-month forward earnings. We talked in the pre-session about Harvard economist Jason Furman that conducted a study that found that while AI investment in the United States accounts for about 4% of GDP, hardware and software, it accounted for more than 90% of GDP growth in early 2025. Now, I'm mentioning this not to give investment advice, but because if AI returns are lower than what's expected, that could potentially trigger some kind of a correction in equity markets. And given the increased share of equities in overall household wealth, particularly in the United States, that could be a bit of a problem. Longer term, however, what I will say is that the importance of AI can't be discounted. I mean, generally, as your question suggests, the impact of any new technology, and as Dan was saying, is that it allows you to increase, from a company perspective, increase your sales without hiring more people, right? So it reduces your cost per unit. At a macro level, what that means is that we can then grow our economies unconstrained by our labor force. And in a world where trade is just becoming more expensive, I think that that's actually a good thing. But it also means, on the flip side, that there's a bit of a transfer of wealth that starts to happen, right? If economic output starts to scale in a linear fashion with computational resources, it means that over time, labor's share of GDP actually converges to zero, and income starts to accruing to the owners, or let's say the enablers of compute, as opposed to labor. And in fact, we know that in certain areas that are already ripe for disruption by AI, workers are becoming more redundant, right? We know that in the United States, for example, now the US is pumping more oil than ever before, near record amounts of natural gas. And yet US oil and gas companies today employ 35% less workers than they did a decade ago, right? And so my concern here is that while the disruption to manufacturing jobs, which represented what, like 10, 15% of total employment in the United States and Europe, is what gave us Donald Trump and European populism. And so if estimates are right, we're about to see some 85% of our labor force disrupted to some extent by the forces of artificial intelligence, with most of the short-term, medium-term benefits accruing to business over and against labor. In fact, I would say it's hard to see whose job is not going to be impacted by this new technology. And that's only going to exacerbate what I'll call are the K-shaped outcomes of the last couple of years, with the wealthier households accumulating more wealth and the poorer set sort of seeing the evaporation of their pandemic savings, rising debt levels, and maxed out credit cards. The last thing I'll say is that even if this doesn't come to pass, workers on most rungs of the socioeconomic ladder, I mean, you talk to folks, people are nervous about the future of work. And as far as I know, anxiety is not a good thing for an electorate. And so this could very well continue to play out in dramatic fashion at the ballot box. And so my concern here is that we should start to expect these domestic political disruptions that we've seen play out in Western Europe, in Canada, in the United States, become a bit more of a common feature in our economies going forward.
Okay. Marcos, quick word from you. We're really close on time here. So
yeah, I'll try to be brief. So I just want to jump in in reaction to the scenario that Stuart just laid out. Yeah, I've been asking myself the same question with the labor share of income going down and the implication of that. And the thing that I wouldn't understand at some point is that all the wealth of the wealthy, let's say the equities, all of that, all of those earnings, like those earnings are predicated upon the assumption that these companies can sell valuable things to people, and most of those cases it's about everyday people, I mean to mass markets. So like if that progress, if that capacity to substitute labor for capital in the form of technology and AI, if that advances at a too fast a speed, like the whole thing kind of doesn't make sense. If it advances in a slow enough manner, okay, it's gradual enough so that the transition can be not too brutal, that's fine. But if it goes too fast, at some point in that road, you're gonna get a bump in the form of some crisis of a size that we cannot speculate about. So yeah, I completely agree with that. But the other thing I would say, just to finish, is that we do have to make the distinction between AI and robotics. AI's capacity to substitute for labor, I think at this point is a little bit more advanced and probably will remain a little bit more advanced than robotics. So watch out for everything like sector, service sector, knowledge economy jobs. I would be a bit more optimistic for, let's say, humans' capacity to contribute in things that are a little bit more brick and mortar. But that can include very advanced professions, such as the ones that we were talking about earlier, that will be necessary for the nation building projects. So yeah, honestly, it's really hard to see where things will go, and I think we just have to just keep on track of the news here to monitor the situation.
Okay, great. Thank you, Marcos. Now, our final question is, we're looking at REAC as the mandate of the Receivables Insurance Association is to help Canadian businesses trade and grow securely at home and abroad. So our final question is going to be around considering trade wars, tariffs, and other economic stressors. Is trade credit insurance an effective offensive and defensive strategy for Canadian companies domestically and internationally? Marcos, what's your thought on that?
Yeah, just very big picture takeaway from everything that we said during the session. It's become clear that the range of possibilities, the range of outcomes in what can happen in what matters to business has become so much more broad and unpredictable. The innovation that insurance brings to the table is to allow you to distribute the risk in a much more balanced way across all those different scenarios. And in the case of trade credit insurance, that applies to protecting your top line. So it's just, it makes, for me, it's just a tool that makes a lot of sense in this kind of scenario. And it allows you to, for say, in the case of what's going to happen with trade policy in the United States, do I want to keep access to the US market? It allows you to do so in a way that is a little bit less anxious than it was. So I do think that it's a tool that makes a lot of sense.
Dan?
Yeah, I would echo those comments, but I'd look at it in terms of, I think you were talking about defense and offense. If you knew that going forward, everything was going to be perfect, monetary and fiscal policy weren't going to make mistakes, there'd be no pandemic, there are no wars, no political upheaval, and so forth, you wouldn't need credit insurance, right? You know, everything was going to work perfectly. Well, no, you would need credit insurance. Sure, part of credit insurance is preventing against non-payment, people not paying you back. In the perfect world you just talk about, you wouldn't worry about that. But a lot of our clients use us for a different purpose. They use us for sales expansion. So, for instance, I'll tell you about an incident. We have an agent. An agent goes to a prospect. I'll call him Prospect A. And he asks Prospect A, how much did you sell to that buyer B? And A says, well, I sold $100,000 last year. He wanted to give me a credit line for $200,000, but I was uncomfortable with that. And our agent looks up and says, we have $1 million of exposure on him. We could have given you that $200,000 credit line. You left $100,000 on the table, and now you have a product, trade credit insurance, that has an actual return on investment. It's not just a cost.
Final word to you on that one, Stuart?
Yeah, I mean, I don't disagree. I think, look, it's easy to look at what's been happening, not just the last year, but go back 5 years, even before that. You have disruptions in the Red Sea, you have the war in Ukraine that's blocking access to, Black Sea ports. You have obviously China and the US and the impacts of climate change, low water levels, the Panama Canal, threat of pandemic. Like there's no shortage of things that we can look at that would make us worried about the future of trade. I happen to think, and obviously, take it for where it's coming from. I'm a trade economist, but like the future of trade, like trade's not going anywhere. Humans are traders. We've literally been trading for thousands of years. I will say we will probably continue to trade for another 1,000 years. Like even take the U.S. China example. The Chinese economy is hardwired to produce more than it consumes, right? And that's a benefit of actually having a command economy. The U.S. economy, conversely, is hardwired to consume more than it produces. And that's the benefit of, and that's a feature of a capitalist economy, especially as, the president is shoveling more money in the way of stimulus. And so that's a structural driver of global trade. I think, as long as one company benefits from sourcing one factor of production at a lower cost, others have to follow, or they just simply get priced out of the market. The difference is trade now has become riskier. It's become more expensive, if you will. And so, what I think now is whereas supply chain management in the past was really just about companies reducing their costs, companies now are balancing those sort of competing interests of, you're keeping costs down. Some are still worried about their carbon footprint, but also enhancing resilience, right? In a world where trade has become more full of frictions and more expensive. And I think trade credit insurance, frankly, is part of that management of your resilience. And so I think, if anything, trade credit insurance is maybe more relevant now than perhaps it has been over the last 10, 15 years.
Okay. I'd like to ask each one of you to give us a key takeaway for our discussions for today. We've had a lot of stuff on the table that people have been listening in for. So let's start with you, Dan. What is your key takeaway for Canadian business as we're heading towards 2026?
I think the big issue for the global economy and for Canada is to invest in artificial intelligence. Stuart is right that things have gotten a little bit more exciting than is really justified at this point. I mean, I remember when laptop computers came out, it was going to change the world with productivity. Well, it sure did help. No two ways about that. And I think that AI will be a very big help as well. But the excitement is a little bit much. And I would suggest that I would borrow that famous phrase from Canadian hockey player, I think it was Wayne Gretzky, that to skate where the puck is going to be, and that's where it's going to be. So I would suggest that that is perhaps the single most important thing in looking forward for the Canadian economy. It's not just diversifying trade this year or managing the budget this year or managing social programs. I think that's where we're going to see a lot of value added over the next 15, 20 years.
Okay, thanks, Dan. Marcos, what's your key takeaway for Canadian business?
I think that in terms of strategy, just the importance was what I've learned definitely throughout the past year, the importance to try to take the noise, the everyday noise of volatility with a pinch of salt and focus on the long-term trends. Don't lose track of them, especially since so much of our discourse is just shaped by the media. Read our research, read the research from the colleagues. We try as much as possible to take like a little bit of distance and things like what we've said during this conversation. Geography is destiny. Technology is structuring. You don't let yourself be distracted by all the chatter, especially in an era of social media and so on and so forth, and really value the importance of those kind of like tired and true maxims of how the world is evolving to structure your strategy.
Okay. And to you, Stuart, what's your key takeaway for Canadian business?
Sure. Thanks, Janet. I'll boil it down. Actually, I'll go back to what Dan said, and I'll boil it down to one word: invest. Like, now is the time. Invest, 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 invest. Like, if you're business, if you're government, financial institutions, now is the time to invest, not to retrench.
Okay.
And of
Gentlemen,
course, leverage trade credit insurance.
Okay, thanks. That's pretty much it. We've gone a little bit over time, but I really appreciate people staying with us. And gentlemen, thank you so much for sharing your time and your insights with us. It was a great discussion. Really appreciate it. Dan North is Senior Economist North America for Allianz Trade. Thank you, Dan. He's based in the US. Stuart Bergman is Vice President Chief Economist at EDC. He's based in Ottawa. And Marco Carias is the Economist North America for Coface, and he is based in Paris. So a semi-global panel we've had here. Thank you, gentlemen. Very nice to see you. Good luck in 26.
Thank you. Bye.
Bye-bye. Okay, so now the Receivables Insurance Association is a national association with that mandate to increase awareness, technical knowledge, the usage and distribution of credit insurance in Canada. And Michelle Davey is past chair of REAC, and she's here to share just a few words about the organization. Hello, Michelle.
Hi, Janet. Thank you so much for introducing me. And thank you all for joining us. Let's keep this momentum going. I'm Michelle Davey, longtime member, former chairwoman of the board, and very excited to have this event brought to you today by EDC. Thank you, EDC, and thank you, panelists and Allianz Trade for the platform. If you found value in this event, we invite you to take the next step and become a REAC member. Membership unlocks access to a dynamic community and a host of exclusive benefits designed to elevate your professional journey. And one of these things I did using AI, which I love Dan's blackmailing AI. What a great collection tool that would make. Think about that. But back to our benefits, I used AI to draft a letter, and in our long list of benefits, one of them is special drinking engagements, and the AI turned that into special drinking engagements because great ideas start with great conversations. And didn't we have some great conversations today? So what are the benefits of being a member actually bring you? Access to the market and insider insights, networking events that connect you with industry leaders, board participation opportunities for our Tier 1 and Tier 2 members, guest attendance at board meetings for non-voting members, committee involvement that shape REACT's direction. Your logo can be featured on our scrolling website banner with a link to your homepage, personalized video endorsements that you can use for your own site. And I've used them for mine. So you know what? And when you're at the gas station pumping gas and people are recognizing you because you've done a video, let me tell you, it's something else. So educational opportunities. We have some great educational videos and online learning tools. It's amazing. Underwriting awareness program participation, influence on social media strategy, direct feedback forum with our trade credit underwriting community. That is huge. So if you're at the table, you know who is a key player here in Canada. So there you go. These are our great benefits. We're looking forward to seeing you at the next REACT event. Whether you're looking to expand your network, amplify your voice, or contribute to industry innovation, REACT is your platform. Become a member today. Call us.
Okay, thanks very much, Michelle.
Thank you.
So thank you very much for EDC joining us today and helping us put together this webinar. Without their support, it would not have been possible. So a big thank you to the folks at EDC. And as a final thank you, I'd like to thank the technical team that's been working all that magic in the background, making the slides change for us and taking care of everything so there were no hiccups. So thank you very much to the technical team at Allianz. To learn how your business can trade and grow securely, please reach out to one of our members at the Receivables Insurance Association of Canada, receivablesinsurancecannada.com, where you can find our social media channels, podcasts, accredited courses. And that completes our webinar. So thanks again to our economists. Thanks to you for joining us and taking the time. I'm sorry we're a little bit long, but I hope you enjoyed the conversation and got some good benefits. I'm Janet Eastman. Thanks very much. Remember, cover your assets and trade securely.